afternoon, everyone. Thank you for joining us on this Wednesday afternoon. My name is Gary Sarkisian, and I'm the Director of Education and Content at CFA Society Boston. We have a great presentation and discussion lined up for you today, and I am personally excited about this program myself. Before we kick it off, though, I'd like to make some quick housekeeping comments. First, as many of you know, our fiscal year will come to a close this month, so I thought I would take a moment to thank each and every one of you for your support and participation over the past year. We've had an eventful year, to say the least, but I've learned throughout the course of my time here at CFA Boston that our members and volunteers are quite resilient when faced with challenges. In the coming fiscal year, I'm looking forward to building on our successes of this past year, and hopefully our lives can go back to normal as well. As effective as we are with virtual programming, there are certain qualities that will continue to remain unique to live in-person events. I hope to see you in person again soon. In addition, I wanted to thank the outgoing members of our Education Advisory Council for their service to our society, and on the same token, I'd like to welcome our newest members of that council, who will be joining us on July 1st. Looking forward, the planning process continues, and we've got a great lineup of events to officially kick off the new fiscal year starting next month, and with even more to come after that. As always, remember to visit our website, cfaboston.org, to view and sign up for the latest events. You can also follow us on Twitter to receive reminder tweets of any upcoming events as well. Our handle is @CFABoston. Now let's turn to today's program. Going into the pandemic, commercial real estate was undergoing disruptive changes while also riding in the front seat of an economic expansion that many believe was already long in the tooth. Fast forward to today, and some of those secular trends within various property types have been both reinforced and have even accelerated. However, we're also seeing the fortunes flip for other property sectors that were once putatively considered to be less risky. Work from home, social distancing, mandatory lockdowns, quarantine advisories, reduced business hours, the greater shift to online retail, the list goes on. The bottom line is when people are not out and about, then there's not a lot of commercial real estate being utilized. Is this pandemic's impact temporary, or have the fault lines materially shifted in the commercial property landscape? Although history doesn't necessarily help us predict the future, it does provide a useful guide, and our guest today has a very deep history in the commercial real estate market, having seen booms and busts in even prior pandemics. It is my pleasure to welcome our distinguished guest, Sonny Kalsi, president of Bentel Green Oak, a real estate investment and management firm with approximately $50 billion in assets under management. His predecessor firm, Green Oak Real Estate, was founded in 2010 and grew to $12 billion in assets before merging with Bentel Kennedy to form Bentel Green Oak. Prior to that, Sonny was head of co-head of Morgan Stanley's real estate investing platform, which at its peak had approximately $100 billion in assets under management, spanning 33 countries. Before we begin today's presentation, I'd like to remind our audience that your microphones will be on mute for the duration of the webinar. After the presentation, we will hold Q&A. If you would like to submit a question to our speaker, please feel free to do so at any time during the presentation using the chat or question feature of GoToWebinar. This presentation will also be recorded, so a replay will be available afterwards. So without further ado, Sonny, please take it away.
Thanks so much, Gary, and thank you everyone for the opportunity today. I really appreciate it. I had the opportunity to, I think, speak to the CFA organization in Chicago a few years back. And, you know, as I've told Gary, I said, you know, I like doing this in person much better. I think I refuse to acknowledge that this is the new normal. I say this is the current abnormal, and I look forward to the day where we can be back into a new normal. So again, thank you very much. What I'd like to do today is put some slides together to just kind of walk through kind of my view of what's going on from an overall market perspective, and really as it impacts real estate. I have to give you all my disclaimers. I'm not an economist, so I make I do leverage some economic data and some other stuff that you'll see in the presentation here. But you know, I think even though I'm not an economist, a big part of our job is to try to get a sense for where we are, where things are going, and then think about that as an investor. You know, maybe just a little bit of just background context. So let's see here if I can control this or not. All right, great. So I'm going to do no advertising, but I want to give you a little bit of context about the firm. You know, Gary kind of gave a little bit of an overview. So, you know, Bentel Green Oak, or BGO as we affectionately call it, we are a global manager of real estate. We've got about 50 billion of assets under management around the world. North America, Europe, and Asia. I've been an investor in the real estate space for my 30th year. It kind of pains me a little bit to say that, but it's been 30 years. And I've had the fortune in my career of actually living and working in Europe and in Asia. In fact, I was in Asia for more than 10 years. And I say that just because I think it's been helpful for me, at least in terms of having some context for what's going on around the world as an investor and how we think about things. And clearly that filter has changed very radically over the last 3 or 4 months. So let's start with some charts. So first of all, another disclaimer, I'm going to apologize. These charts were probably put together about a month ago, maybe a little bit later than that. And things are just harder for us to update these days. We use these for our investor conferences, so that's the purpose we put them together for. I would say, given the volatility in the world, you can update these things every day, and the trend lines don't really change. Like if you look at what's going on in the equity markets right now today, it's a big down day for REITs. So just kind of high-level comments, right? So number one, kind of state the obvious. The volatility index, the VIX. We haven't seen this level of activity, since actually the financial crisis. And in fact, in March 16th of this year, the VIX peaked at 83, which was higher than it ever hit during the financial crisis. I've just been struck by that. I mean, I think if you want to give some relative comparison, I mean that's pretty nuts. Obviously, it's come down since then. It's our view that we're going to still see, though, a tremendous amount of volatility in this index. Similarly, 10-year bond yields, right? If you just look at, this chart is from kind of April of 09 forward, and you look at where they were, the amount of easing that we've seen, the amount of fiscal stimulus we've seen is unprecedented. And I think it's actually probably the reason that things are probably holding together right now better than probably I would have guessed they would have, if you'd asked me where we were going to be 3 months ago, where we'd be today. Now, that comes at a price, and we'll talk about that in a minute. 10-year bond yields around the world. I think if you think about when the U.S. started QE during the financial crisis, Europe really didn't start till August, really till summer of 2012 when Draghi kind of put a line in the sand and, kind of said the euro was going to stay together. And you've just seen how things have synchronized and moved down together. And, I think one of the challenges we have right now is I think we're clearly in a time period here where these interest rates are at an unprecedented low level. I would argue maybe not a sustainable level. We have something like a third of OECD countries where government bond yields are actually negative, and actually 2/3 on a real basis, on an absolute basis, and then 2/3 of the world were effectively on a nominal basis are negative. Now, I lived and worked in Japan for 8 years, from 98 to 06, and I had a point of view when I moved back to the U.S. in 06 that the rest of the world was becoming like Japan. Japan's had basically zero interest rates now for 25 years, and I think that's something we can talk about if people are interested. But I think that it's a little bit telling for where we are right now from a global perspective. So what does this mean? So a couple of different charts here. I'll take a second to just talk through this one. You've heard about V-shaped recoveries, U-shaped recoveries. If we really have a second wave of the virus, is it going to be a W-shaped recovery? The reality is no one knows. So on this chart, the green line is what the actual recovery pace was coming out of the financial crisis. So if we just look at real GDP, U.S., it took about 3.5 years to kind of get back to where we were pre-crisis, right? So then I've included some forecasts here from Moody's, from Oxford Economics, and get a sense. Oxford Economics is calling for much more of a V-shaped recovery, but honestly, I think this timetable, V-shaped recovery, is probably later than most people are thinking, and certainly more so than the politicians in our country are hoping for. But even this V-shaped recovery says it's going to take us, almost 2 years to kind of get back to where we were at the end of December of 2019. And then more of a U-shape or Nike swoosh, recovery from Moody's. They're calling for it to be 2.5 years. Clearly, this there are cases that are worse than this. But if you just use this as a couple of examples, it gives you a very big it gives you some different interesting bookmarks for where this could be. But in all scenarios, in these scenarios at least, it's not as long as it took in the GFC. And I actually believe that an economic recovery taking as long as it took in the GFC is definitely not out of the cards. That's really critical because even though I said before, I'm not an economist. Look, real estate is, I always say real estate's the tail of the dog, right? The dog is the overall general economy and what's going on with job growth, wage growth, household formation, et cetera. And so I think that, and then real estate's the tail. We follow what's going on from a broader perspective. So we can't really, as an industry, be out ahead of this, right? We're going to basically be, I've always had the view that real estate's a lagging indicator of what's happening from an overall economic perspective. If that's the case, then we got a couple more years of pain to come. Trying to, let's see here. We have a lag. Oh. The joys of technology. Sorry, I haven't. I know, Gary, if you can help me get to the next slide. So why don't I keep talking, and then we'll get to the next slide. We'll catch up. So part of this is then what you have to put into context is where are we? What does this all mean from the standpoint of overall economic? What does the overall economic activity mean from to the real estate market? What's this mean in terms of fundamentals? Where were we going into the downturn? And what is it going to mean from the standpoint of when we might get to a recovery or not? So one of the, I'd say, good things, if you will, about where we were from a market perspective going into this downturn versus the GFC is the overall real estate market itself was in better shape. But the summary of this is that some people are calling for a V-shaped recovery, U-shaped recovery, et cetera. I think that in any event, most of the people's, most recoveries here are ahead of the pace of what actually happened during the financial crisis, which is 3.5 years. So the next slide, which you're not going to be able to see, basically says, okay, what does that mean for the real estate market? So I think, oh, look at that. There we go. We're back. The slides are back. All right, awesome. So what does that mean for the real estate market? So here on page 8, so the first column is kind of where, actually I'd look at the middle two columns, right? So the middle column on the vacancy availability is where vacancy rates were by sector going into the financial crisis, right, in 07, 08. So we had 6.4% in apartments, which was now 4.3%, so 200 basis points lower going into COVID. Office, vacancy rates were about 50 basis points lower. Retail was about 30 basis points lower. Industrial was significantly lower. Now, part of what we've got going on is, and then on the right side, the construction underway, a lot more multifamily development underway, really no retail development, and then some more, industrial development. Part of my view and what's happened with the real estate market, what's happened with COVID is there were a lot of long-term secular trends that were in place, that were underway, right? So from a long-term secular perspective, we had, so retail has been in secular decline, right? I don't believe it's a cyclical decline. It's been a secular decline. COVID has accelerated that, right? So all of us who, you know, in our case, our business, you know, most of our team has been working from home for 3.5 months now. You know, I think that the acceleration of what people would buy off Amazon, for example, versus going to a store to buy what people were, you know, on online grocery shopping and the delivery of that, you know, those secular trends have been, in my view, they've been accelerated by COVID, and I'm not sure they're going to come back. So I think that, you know, the further acceleration and growth and demand for industrial, you know, I think is, you know, has just accelerated, and then the decline from a retail perspective is also accelerated. And again, we'll talk about more of that. So look, the next slide, page 9. You know, then says, okay, how long did it take the real estate market to recover, right? So again, that's one where GDP took 3.5 years to get back to where it was on an index basis. You know, Real Capital Analytics, which is probably one of the better data sources in our industry's thought, and this is a weighted average, right? So the U.S. is a big country, there's a lot of property types, but if you took the weighted average, we were down 35%, kind of peak to trough. And that, you know, was kind of, it took about 2.5 years to get peak to trough there. And that's partly because in a private market, price discovery takes a while. And then from that point forward, it took 6 years to get back to where we were, you know, where we were pre-crisis, right? And so again, I think that is informative, maybe somewhat depressing for people, but I think it's, you know, I think it's something that we just gotta keep in mind as we look at the market right now. So that's all been primarily the private markets. I'm going to spend now a few minutes talking about the public markets, all right, and the intersection and interplay between the public and private markets in real estate. So just a few comments there first. The REIT market in the U.S. really does, it is more correlated in my mind, probably to the overall equity markets than it is necessarily to the private real estate markets. Over time, I think that they, you know, they do track each other pretty well, but there's definitely a disconnect. And I think that, like a lot of things, I think the public market's in a position to reprice much more quickly than the private market is. And we've seen that in real estate already. So what this chart shows is just how's the REIT index, XLRE, done versus the S&P 500. And, you know, you can see it generally has tracks, you know, pretty consistently with it. COVID hits, everything goes down together. What the bottom part of this chart shows is on a relative basis, you know, real estate, the REITs have started to underperform the broader market. And I think it's, you know, for a lot of reasons. One is, you know, lack of new equity in the industry, a lack of liquidity, certain asset classes especially really getting hit hard. The exception has been industrial. You know, if you look at like Prologis, which is the biggest and, you know, arguably the best industrial company in the world, you know, there's been volatility in its share price, but it's more or less bouncing around kind of where it was pre-COVID. And I think that's, again, reflective of some of the longer term secular trends I mentioned before. And then if you look at it, you know, by different sectors, right? Again, we're a global investor, so we think about this from a global perspective. You see, you know, here at this point, you know, the S&P was down at this point. We did this chart by 15%. Industrial REITs were down 19%. The European stock index was down 26%. The RMZ, which is the broad measure of US REITs, was down 34% at this point. Host Hotels, which is probably the best quality publicly traded hotel company, was down 41%. And then you can see what's happened with mortgage REITs, and then in this case, European retail down very significantly. We'll talk about the mortgage REITs for a minute, right? So I would say, you know, it's almost become a truism. You know, Gary mentioned it in the intro. This is, I don't know which downturn this is for me, number 3 or 4. But certain things just keep happening every cycle. And you've got certain industries and businesses that continue to finance themselves short and lend long, right? And so that mismatch is fine as long as the market is doing all right and there's liquidity, and then it really, you know, blows up in people's faces when they're no longer when that gap all of a sudden. So I'll give you a good example, right? So you have a number of the mortgage REITs here on page 12. They're listed. What would happen with the mortgage REITs is they finance themselves oftentimes with overnight repo. So they'll get this financing. The financing is not, in some cases it might have a little bit of duration to it, but it's probably not more than 1 or 3 months. Most of it is overnight. There's a huge mark-to-market risk around it. And so what ends up happening is even though the private lending books aren't necessarily getting mark-to-market on an overnight basis, a lot of these companies own, for example, CMBS. Right? They'll own CMBS bonds. It's a way to actually generate higher yields with leverage along the way. Those CMBS bonds do get marked, and therefore what ends up happening is the banks providing the repo call that repo in again overnight. Maybe have some degree of forbearance, but broadly speaking, it kind of hits these companies' bottom line very, very quickly, and that's why the mortgage REITs have traded off very significantly. Look, I think a lot of these are going through a restructuring. So TPG has announced a recapitalization from Starwood. Colony is out in the market trying to recapitalize right now. There's a couple of mortgage REITs that are not listed on here that are also going through the same process. It's my view that half this sector will disappear in this downturn. They're just not going to be able to get through it. And it partly depends on how long anyone believes the duration of this is going to be. When do we get through COVID? And when do we actually start getting into a real recovery? It's going to put a lot of pressure on a lot of these companies. I've talked a lot about some of the other asset classes. I've not talked as much about hotels. Look, hotels have been, decimated by this, right? Hotels, by their definition, most of your tenants, if you will, come and go every day. And so, when you have travel shut down, which is really what the left side of this graph shows, it has a direct and immediate impact to hotels. We have 4 hotels in the U.S. in our portfolio. They were mid-80s occupied on March 1st, and by the end of March, they're effectively 0% occupied. That's indicative of a lot of the industry. So I think, now one thing I would say, at least with hotels, it's my view, is whereas I think what's happened with retail is very much a secular decline. I think that the retail stocks are off, and I think it's because people have just realized that a lot of what's happening in the industry, not everything, not 100%, but a lot of what's happening is a secular change, and it's been accelerated. It's our view that what's happening in the hotel industry is cyclical. It's deeply cyclical. It could last a while. Gary mentioned that I've lived through another pandemic. I actually lived through SARS in Asia when I was out there, both personally, but also as an investor. And there, what we found is it took the hotels about 3 years to get back to RevPAR, where RevPAR was before the crisis. For those of you who may not know what RevPAR is, it's a very simple metric. It's kind of what is a room generating in terms of revenue, per night, right? So it takes room rate times occupancy. So it's a very simple metric, but it's a really important metric. And in Asia, it took 3 years, right? Because what ends up happening is, believe it or not, the first travel that bounces back is leisure travel. Certain types of leisure travel, especially leisure travel that doesn't necessarily involve airplane flights. Then, what takes longer is business travel, especially group business travel, conventions, et cetera. That takes a lot longer. I'm sure a lot of you probably can ask, I ask the question to everyone, but when are you going to be ready to get on an airplane again? When are you going to be ready to go to a convention again, right? So again, my own view is, I don't know if it's 2 years or 4 years, but in some period of time, I do believe we'll get back to, I think the hotel market will get back to where it came from. The issue with the hotels is that they have a ton of operating leverage in the hotels, and then you put financial leverage on top of that, and this is something that can hit your bottom line very quickly, unfortunately. So what this all then means is, if you just put it all together, is what does this mean for rental growth, rents, and expectations around rents? So what the top chart is kind of what happened during the financial crisis. So this is put together by Green Street. Green Street, I think generally speaking, is the best overall real estate research in our industry. Really thoughtful, very deep, and very analytic, and they cover all the big, all the important REITs. So with this, what we have seen is in the financial crisis, this really isolates office. The office market took 8 years to get back to the same rent levels as it was pre-crisis. And then, in terms of what Green Street was projecting on a go-forward basis, from again, pre-COVID, was that, that office rents and industrial rents will continue to grow. Industrial probably above inflation, just because of the secular demand we talked about there. And then, office, again, generally, my view is office growth generally tracks job growth, right? So it's a function of GDP growth, but then you got to layer on job formation, and that's where it tracks. And then Green Street had a view that retail was going to continue to lag off because of these long-term secular declines that were going on in terms of, just shopping patterns and what people are doing. Okay, so that's before. Post-COVID. Now this is as of April. Their research is done every few months. So what you can see here is that, for logistics or industrial, they have a view that there'll be a short-term dip. I think there will be a short-term dip, just because I think that what less COVID, more because of the recession that we're in and will follow. I think companies will pull back a little bit, but then I think it's our view that demand is going to continue for industrial. May not be at the same pace as it was before, but ultimately we actually think Green Street thinks by the time you get to 2024, trying to look at the chart here, it's more or less where they thought they were going to be anyways. Office, not there, right? Office rents and occupancy are very correlated to economic growth, and therefore they're calling for a more significant decline in office rents. And on this chart would say that it would take, their view is it's going to take 4 years to get office rents back to where they were pre-COVID. And then this just crushes retail, right? So retail has just been, again, the secular decline gets accelerated. And there's a lot more pain to bear here, from a retail perspective. Look, what falls in the retail bucket are a lot of things, including restaurants. Gary and I were talking about kind of where things are in terms of opening up, and can you go to dinner? Can you sit outside? Can you sit inside? Look, it's our view that about half the restaurants, this is a broad comment, but about half the restaurants will never reopen again, especially depending upon how long the downturn is here. And that's a big component of retail. It's actually been one of the healthier components of retail, because I think experiential retail, that type of thing has had to replace a lot of other physical retail that people are now shopping for online. So if you've got this, effectively secular decline going on, and in terms of what's going on with restaurants, then the retail market's in tough shape. My last slide. So I'm going to get completely away from the U.S. and talk a little bit about the other side of the world. So with Asia. So I do think one of the things you got to be really careful to do is kind of paint all real estate markets and all asset classes with the same brush. So for example, Tokyo, our view, even though you look at all the prior slides I just went through, you have to have a more conservative, cautious view on the office market in the US for some period of time. It's going to be much harder to underwrite where rents are going to be, where occupancy is going to be. I haven't even touched on what's going to happen. Are people going to take less space, more space? What's going to happen? I'm happy to talk about that in the Q&A. In Asia, it is our view, especially a place like Japan, that office is going to remain strong. That's partly cultural. It's also partly practical, right? So the practical part is, believe it or not, as technologically advanced as Japan is, it's probably been the part of the world where our team has had the hardest time working from home. It just doesn't work, right? People live in generally very small apartments. They don't have a lot of space to, get away from children or dogs or anything else. But the technology is not good. There's very little broadband at home, et cetera. So you've got that one factor, but the other factor is just the way work happens in Japan. It's a very hierarchical structure, et cetera. It's not it's not conducive to people working from home. And so, in fact, if I just think about our business, our office in Japan was the first one to reopen, and is now back at full occupancy, and has been. And thankfully, we haven't had any issues yet from a health perspective or anything else. And so, it's our view that even though we're cautious on office in the U.S., we're keeping a close eye on it in Europe, depending upon the market, et cetera. In Asia, but especially in Japan, more limited degree in South Korea, we're pretty bullish on it. And we think it's going to continue to charge ahead. And part of it is on these charts, it's that the market's in pretty good shape, right? Vacancy is pretty low. New supply is absorbed. It will get absorbed in our view, and there's very little coming going forward. So I thought I would just throw that out there as an anecdote before I then pause and really go to questions. So. And I'm happy to kind of go back to any of these slides. I'm happy to kind of do whatever people would like from a Q&A perspective. So I'll pause there. Gary, are you back?
Thanks, Sonny. I really appreciate that. And my apologies to the audience. Had a little bit of a technical difficulty on my side, so I hope it wasn't too disruptive. And let me know. I took the slides down, but if you need to reference any of the slides, let me know. I can more than happy to bring them up. I want to give our audience a chance to put their questions in. Just remember, just as a reminder to the audience, if you're wanting to submit a question, you can use the question or chat feature, and we'll try to get through your questions as quickly as we can. I thought maybe I would kick things off, and just as a continuation, extension of a thought on your last slide. So you referenced the market in Tokyo, and I really wanted to get your perspective from an international lens. And one particular market that came to mind for me is Hong Kong. And with the recent national security law that's being imposed by mainland China, things are being clamped down. You've had the pro-democracy protests. How do you, as a real estate investor, look at your opportunity set in a market like Hong Kong today? Because you mentioned earlier that it's a different mindset, different cultural mindset, and of course, office is a different makeup there. But there's also the aspect of tenants thinking about, corporate tenants over there thinking about, oh, well, if our informational access to Western social platforms are going to be restricted, we might not be able to operate. What is your thoughts on that market?
Yeah, so look, I think Hong Kong is very different than Tokyo or Seoul, right? And I intentionally did not really say that we were, aggressively going after Hong Kong for that reason. So I lived in Hong Kong for a couple of years. I love the city. I think it's super dynamic and super, and I actually think they've done a great job over the last 23 years, post handover, to really kind of keep that dynamism. I think that's part of what ended up happening. So we weren't actually even focused on investing in Hong Kong over the last 7 or 8, 9 years. About last summer, about 12 months ago, we finally said, you know what, we're starting to see some cracks in Hong Kong, more just typical late cycle stuff. And so we didn't even have an office in Hong Kong at that point. We opened an office, and one of the senior folks from our team that was based in Japan is actually, was born and raised in Hong Kong. And so, he moved back home, if you will, and he moved home the weekend before the protests started. Right, and so he's there for all of that, and then just as the protests actually started settling down, COVID hit. So I joke with him. I say, you're like the bad luck charm, man. But all kidding aside, look, I think the challenge with Hong Kong is very simple. It's not cheap, right? So valuations are high. They are correcting. I think part of the issue right now in Hong Kong is just getting any conviction around what value really is. And then I think, look, what's going on from a political perspective in Hong Kong with mainland China, it's hard to underwrite, right? I think there are certain things you can't underwrite. I just went through a bunch of stuff in terms of, okay, what's going to happen with COVID and everything else, but you can underwrite at some point. Look, I don't know if we're going to have a vaccine in 6 months or 18 months, but I'm actually quite confident that 3 years from now, COVID will be in our rearview mirror. The issue with Hong Kong is it's hard to say any of that definitively, right? Now, interestingly, the business community in Hong Kong has been actually overwhelmingly supportive of what mainland Chinese are doing. Now, the cynic would say they don't have a choice, but the pragmatic person would say, look, if it just provides stability, as you know, Gary, the biggest thing that the market hates is uncertainty. And I think if you take uncertainty out, people know what is the status quo, what's going to happen, where is it going to be, then I think you can invest against that. Look, people have made a lot of money investing in Shanghai and Guangzhou, Beijing, right? In a place that's, in a market that's much less open or much more restrictive than Hong Kong will ever be, in my view, maybe until 2047. So I think part of that uncertainty, but I got to tell you, as an investor right now, we're completely on hold on everything with Hong Kong. It's kind of hard to invest in it.
Gotcha. So we got a question from the audience here about the mortgage REITs. Does your comment about half of mortgage REITs not surviving apply exclusively to commercial mortgage REITs whose stock performance was in the chart you showed, or are you including residential mortgage REITs as well?
Yeah, well, not so much the residential. From my perspective, I'm really talking about the commercial mortgage REITs, but I'm not just including the ones on that chart. The ones on the chart were some of the bigger cap ones. There are a lot of others. So look, I think the bigger ones are going to survive. Blackstone is going to survive, right? They're just, they're good, they're smart, they have access to liquidity. They're the last ones that anyone's going to pull any liquidity from, right? So if I put that as one bookend of like, if I had to bet, and what we do for a living, we do invest in the public markets and private markets. So, there's someone I would bet against. TPG, on the other hand, is also now going to survive, but they also had to get it's public, they had to get a $325 million capital injection from Starwood in order to get to that point, right? To be able to deleverage and do other stuff. So there are a lot of smaller mortgage REITs who I think are just going to be, look, here's what happens, right? It's like, at the risk of using a bad analogy, the ship's at the iceberg. There are a limited amount of lifeboats and life preservers, and the people throwing out the lifeboats and life preservers are throwing them out to the people they think have the best chance of surviving, like Blackstone, right? And then KKR's TPG's mortgage REIT has got a great management team. Again, look, they ran into a short-term funding issue, but they're generally well regarded. They got a life preserver, right? They got into a lifeboat. I think a lot of the smaller folks, I think when people have to make decisions, there's not a lot of life preservers to go around. They're the ones that are going to, well, that's such a terrible analogy, but they're the ones that are going to go down with the ship, in my view.
Just wanted to get more specific on the commercial mortgage REITs, because that was a space I used to follow in my prior role. Do you have any opinion on Ladder Capital, just given the fact that they do not only balance sheet lending, but they also have a multi-cylinder, they own triple nets. Some of these commercial mortgage REITs, by the way, they're not exclusively balance sheet. I mean, they do CMBS conduit financing, and they may even be kind of diversified REITs, but Ladder, I only mentioned them because they are one of the few internally managed REITs out there. And the CEO, I find him to be pretty savvy. He was actually fairly bearish. He called for Fed rate cut last year. What are your thoughts on them?
Yeah, I think Brian's a really smart guy, right? So I think can look. I don't know. First of all, I have to say we don't follow them closely enough to really know. They have been doing loan sales. They actually sold a significant amount of their loan book at prices I think that surprised most people in terms of the high levels which they got, which is a good sign. I think that's indicative of. Look, I think they're well run, so I think they did a good job. I think they sold their loan book for 97 or 98 cents because it was a good loan book. I would say that I wouldn't bet against Brian Harris, never would. So I believe he would figure it out. But you touched on something, Gary. I think has been the issue for a lot of folks. And again, I don't know this specifically for Ladder, but I think more broadly, it was the CMBS trading and some of the other esoteric stuff that people do that is going to get them in trouble, right? I mean, because I think, look, here's the truth of the matter, and this is not just a real estate issue. This applies to all asset classes. Private asset marks move more slowly than public marks, right? Period, right? So look, we own 4 hotels. Every one of those loans, if my lenders are on, I apologize, I'm going to say something different when I have my negotiations with you, but every one of those loans on paper is impaired right now, right? The hotels are closed. The good news is we're a deep-pocketed investor. We're funding basically interest expense out of pocket. But if you just did your own analysis, you did a rating agency analysis, those loans are impaired, right? But those loans are not, what any lender is doing in terms of marking them is probably based on their own criteria. But it's not like a CMBS bond where the CMBS bonds are, the market reprices those overnight, right? And so I think that is where the pressure has come. That's what honestly got TPG in trouble, right? TPG's got a good loan book, but what got them in trouble is they had a very big, book of CMBS, right? And when that CMBS got priced overnight to 50 or 60 cents, the repo against that was, due and payable. So.
Yeah. We got a question from the audience. There's a few members of our audience that are more in client-facing roles in private wealth, and so this question is, do you have any ideas of places to avoid or consider in the publicly traded side for advisors serving individual clients? Sometimes they may not feel comfortable looking at company-specific names, but there are a whole variety of real estate vehicles out there, whether in the form of ETFs or whatnot. Yeah, can you provide any color on that?
Yeah, so let me do it this way. I'm going to do it by a little bit high level by sector, right? Like, so what are the sectors that I think, and that's just, look, we have we also invest in public equities, right? So in our public equity book, we kind of put things into kind of a couple of buckets. One is, just what is our core focus, right? So our core focus right now, the only two asset classes that are core focus for us are industrial and multifamily, right? Why? Because we're not worried about mid to long-term demand. We're actually really not that worried about short-term demand either, but in the short term, with industrial, the issue we have is we're in a recession. That's going to impact companies on the margin on what they do right now. But 1, 2, 3 years out, we, Green Street, others believe that the industrial market's back on track, right? Not a ton of value there, but the downside I think is fairly limited also. Multifamily probably then is, so if we take this end of the bookend as the most safe and secure, that's industrial. The next one in is multifamily. So pros and cons. The biggest cons for multifamily are people aren't paying their rent right now, right? And in certain places you've got mayors saying, don't pay your rent, don't worry about it, right? You got that kind of stuff going on. So, rent collections, depending on the asset class, are running between 75 to 95% of what they should be, right? So meaning for 100 tenants, 75 to 95 of them are paying right now, right? Part of that too, I think, is bolstered by the fiscal stimulus, right? So the government keeps writing checks to people, then, it's harder for them not to pay rent. So that's some of the short-term issues in terms of headwinds. What are the positives? Great demographics, right? So number one. Number two, look, there's always a trade-off. People either rent or buy, right? And so where we are now, I think, is, so the good news is asset values are coming down. So in the next year or two, it'll be asset values themselves might look more appealing for someone thinking about buying. The problem is, one, I think financing is going to be harder. I think banks are going to pull back on lending to residential. And number two, people's affordability is going to go down, right? So whether it's wage growth going down, recession, or people having to dip into savings to pay for life, right? So I think those things which are going to hurt in the short to midterm, the housing market, are positive for the multifamily market, right? So those are the two asset classes to feel good about. Look, today's a huge down day, and I've been too busy to kind of get into understand exactly why. But look, we're out buying multifamily today. That's our view. Like, our view is like, we want to buy more industrial, but what we're really trying to do is buy as much multifamily as we can on down days, right? Yeah. Because again, the good news for us is the money we manage in that space is not looking at our performance on a daily or even monthly basis. It's really saying, what's the performance of this going to be over 2 or 3 or 4 years, right? And sometimes, and when I come from a distressed background. That's how I got into real estate in 1990, because it was all distressed, right? So, the right way to express distress right now in real estate is the public market more than the private market. Okay. My bookends, right? So office, multifamily. Now let's go to the other bookend, retail. I would tell your advisors, you got to have big cojones if you want to touch retail right now, right? Simon, I actually believe, is one of the best companies in the real estate space globally. I think it's got one of the best management teams. David Simon's awesome. Not his fault, but his sector is under a lot of duress. I believe Simon will be okay, but there's going to be volatility along the way, right? And so, they're down 50%, right? They were down 70%. They were down 40%. Right? So I don't actually know where they are right now, but there's going to be a lot of volatility there. That, in our mind, comes out of our opportunistic bucket. So anything we would do in retail is going to come out of our opportunistic bucket. Anything we do in hotels is going to come out of our opportunistic bucket, because that could get worse before it gets better, right? So again, we're investing in it. We're investing in some hotels. We're investing very limited in some retail, but our view is that that probably on a mark-to-market basis is going to look worse before it looks better, right? That leaves office in the middle. So you didn't really ask this question, but everyone's probably thinking it. So I'm going to tackle all of it right now, if that's okay, Gary.
Sure, go
So
for it.
office is by far the hardest asset class to underwrite. It's actually the biggest segment of the real estate market. So it's the biggest, if you just take the market cap of what's publicly traded, it's the biggest sector. And by the way, I didn't mention data centers or else. Look, those are gold, right? But they're also trading at 52-week highs, right? So there's no value in them at all, right? Data centers, cell towers, and all that. And I didn't mention senior housing and all that. I think you could put senior housing in the bucket with, I would put it in the bucket, honestly, with hotels.
Okay.
They'll be fine. They got a bad PR issue right now, right? And I don't mean to trivialize the health issue at all, but look, the demographic demand for senior housing is there. Clearly some things need to change. When you have a pandemic, you should not put sick people into a place where other vulnerable people are there. We're like, well, this is all, I'm not indicting anyone. I'm not sure I would have done better if I was in charge, right? But office is the hardest one, right? Now, why is office hard? Because none of us know what this is going to mean. Now, when your power went out, I'm sure you were thinking, really, I would love to get back to the office, because it's just, and look, by the way, everyone cut slack, right? I mean, I kept talking for a while, and when I couldn't move the slides, I was like, okay, something might be up, right? Which is why Gary and I had a redundancy. I said, you should text me yesterday so we have each other's text numbers. So we did do that, right? But all kidding aside, like, I think we're all making the best we can. But I always tell people, look, if you take my business, right, we have 1,500 people. By the way, 750 of them or so aren't working from home because they're actually at property level, right? So they've been there on the front lines, essential services all the way through this. But the other half have been more or less working from home for a while. I would say, I think anecdotally, we're 80% as efficient as we are when we're all together, right? And okay, so unfortunately, you can be 80% efficient and get away with that for a month. You can't run a business being 80% efficient, right? So what does that mean? It means that I at least am working 125% as hard to be the same amount of efficient as I was before. But using that simple anecdote, I really do believe that, I think there are certain things, and you've heard the tech companies, some of them said, Facebook, all of our employees can work from home forever if they want to. Now, what they didn't say is publicly is Facebook pays people a premium. If you live within 5 miles of, this is general. I don't have the data source in my hand, but just give me plus or minus 10% on this, right? I think if you live within 5 miles of their office, they pay you a 20% premium, and if you live within 10 miles, they pay you a 10% premium. And their thinking is they don't want people stuck in traffic. Being in traffic really brings you down. They want people to have flexibility, whatever else. What's a little bit they didn't work as public about is, by the way, if you work from home, those premiums go away regardless of where you're living, right? So the way to say it a different way is they're going to cut people's compensation for working from home. Mm-hmm. If on one hand, I'm really excited to be able to work in my sweatpants and work from home, and that's all great, but then all of a sudden you tell me I'm going to cut my comp by 20% to do that, I might take my sweatpants off and put my, put my jeans on and go to the office, right? So not to pick on Facebook, but they've been very public about it, right? So I just think like you have so many factors at play with office, right? We're in a recession. We're going to be in a recession for a while. That's bad for office, right? So without COVID, without work from home, you got that issue. You've got, look, we are starting, like we're back in Asia in full force. We're actually starting after July 4th to start opening some of our US offices, right? So like a lot of people, for the rest of the summer, we're going to have 25% maximum occupancy. Our plan is right now, the virus will decide, as Dr. Fauci always says, whether this happens or not. But if the virus allows it, our goal is by after Labor Day to go to 50% occupancy in our North American offices. And then the goal is by the end of the year, say after the new year, to kind of be back at full strength, right? So we're going to be staging as well. I think that but I think what's going to happen is, and you're not going to be able to, so people have used this is a real statistic. In 1990, in New York City, the average company took 250 square feet per employee. In 2018, I think that number is down to 100 square feet, right? Now, why? Now, WeWork impacts that, right? But just, look, you've just about open floor plan, densification, all that stuff. It's not surprising. there's no way employers are going to be able to get away with 100 square feet anymore, right? Even when we have the vaccine, even when it's all good, people, I actually believe there's going to be a lot of real, change. Someone used this example with me the other day. I'll use it with everyone. I like speaking in anecdotes. Maybe it's comes up from Tennessee, but if you think about it, before 9/11, let me use this example. If you were able to go to an airport pre-COVID and get on a plane and no one made you take your shoes off, you didn't have to go through the special metal detector, no one really checked your ID, and you got to that plane, I don't know about you, but I think I would get off that plane. I'd be like, I don't know, because it's ingrained. That's the new normal, right? I believe that some social distancing in offices and some of this other stuff, I think it's going to be the new normal. I don't think you can put someone right here and have someone sit right here and be next to each other 10 hours a day, right? Now, it doesn't mean we're going back to 250 per square foot per person, but it ain't going to be 100. I'm actually 100% sure of that. So here's the hard part. I just laid out a bunch of gobbledygook, which you got to mix it all up, and what's the net result of it? So when I get asked a question, I always tell people, you want my honest answer? I don't have any idea. I insert an expletive if you want, any idea where this is going to go. My instinct is the following. I think it will take several years, but I think when we look out in 3 or 4 years, the amount of office space occupied at that time is going to be very similar to what it was pre-COVID. But I think getting there is going to be bumpy, right? That's number one. Number two, in the major US cities, but also places like London, the biggest driver of absorption, which is taking office space in the last 5 years, has been 2 sectors: technology, and we already got them saying they're going to let people work from home, and co-working, right? And look, I think WeWork will exist in 10 years, but it's going to be smaller than it is today. It's going to be a tighter company. It's going to be a better balance sheet and all that. Because I think, look, WeWork's a great idea, right? They just grew too fast with a balance sheet which was overstretched, right? But they're not going to be a net absorber of space, right? That sector is not going to be a net absorber of space. So that's a headwind for the office markets for a while. But the positive is, like I think about our office holdings, they're in big gateway cities. Our average lease life is probably 10 years. So as long as we have credit tenants, I'm going to say it, and by the way, if one of my tenants is on, they're probably going to give me a hard time. It's kind of their problem, what they're going to do with their space. It's not my problem. As long as they have good enough credit, they'll keep paying their rent, right?
Yeah.
So
you covered a lot of ground there, and we're kind of running short on time. So I'm going to try to go through this a little bit like a lightning round. But you mentioned office, retail. I want to touch on multifamily. As a matter of fact, we have a question from James here, and I want to piggyback on top of this question as well, because you seem very bullish on multifamily, and
Yep.
his question is, can you talk about the demand from urban multifamily and the threat from deurbanization? Now, I want to add to that and say that I just saw an article in the journal this week. There was data cited from, I think, RealPage that mentioned that San Francisco vacancy rates shot up from 3.9% to just over 6%. And this is, and it's not, I don't want to say it's just COVID that's related to this. This is a market, these coastal markets, these gateway markets, you tend to see a higher percentage of rent relative to gross income. So there's been an affordability issue.
100%.
So we're looking within multifamily, and this is, I'll let you answer James's question first, but to kind of extend on that, do you have to classify the opportunity set within multifamily? Do you have to look at it as coastal gateway versus Sunbelt or Middle America, for instance? Can you kind of expand on that?
Yeah, look, I think it's totally, I do believe the big coastal gateway cities are going to have, the dense cities are going to have the bigger issue in the short to midterm. Part of it is practical, part of it's psychological, right? We saw this after 9/11, right? Look, there's a significant number of people that moved out in the short term after 9/11 from New York City. There are people saying, who's ever going to work in a high-rise office building again or whatever else? That is a very logical human reaction to something like that. It is my view that will be short-lived. That the driver of deurbanization is going to be relatively short-lived, because I think people will deurbanize and then they're going to wake up. By the way, I grew up in Tennessee in a small town middle of nowhere, so I'm not an Upper East Side New York snob or anything, but they're going to wake up one day and say, what am I doing in the middle of nowhere? I'm kidding a little bit, but I think again, I think all the reasons that made New York City, San Francisco, Boston, downtown Los Angeles attractive, Seattle, are still going to be attractive to people once we get through what I will call this very real psychological and health concern, once we get to the other side of that. Look, nothing like a good recession to make things more affordable, right? So, when I'm saying I'm bullish on multifamily, I'm not telling you I'm necessarily bullish on where rents are going to be for a while, right? I think that we're trying to buy a bunch of multifamily right now. I'm not using last year's NOI to buy it, right? We're using a projected NOI, which is lower for the next year or two, and that's the basis on which we want to buy it. Look, with real estate, the most important thing is demand, right? Well, supply and demand, the interplay, but it's demand. I feel good about the demand, right? So if a market like San Francisco goes from 3% to 6% vacancy in multifamily, even in a short period of time, that doesn't scare me, right? Now, if it went from 3% to 20%, then I would get a lot more worried, right? So I would say, at least again, from my perspective, we believe that the secular trend of urbanization is not going to change. There might be a cyclical downturn and slowdown for some period of time, but we still believe from a global perspective that urbanization is here to stay. An asset class I hate, I usually only reserve hate for the Red Sox, but what I hate, so I shouldn't say this to the Boston CFA group, but I am a Yankee fan, right? Is suburban office. I don't think suburban office is the winner out of this, because I don't think people are going to de-urbanize the suburban office. I think they're going to de-urbanize. They're going to de-urbanize to their home office, right? They're going to, or into a more flexible commuting pattern or whatever else. So I don't want to go. I'm already screwing up your lightning round, so I'll stop talking.
No worries. That was really helpful. So maybe kind of switching gears, and we're going to be jumping back and forth, but really switching gears to retail. I know it's an area that's you pretty much have thrown it in the in the corner and in the dustbin. Yeah, it's. But you talked about Simon, and by the way, just for context for the audience, we kind of switch back and forth between public and private players, just because. Sometimes it helps to put things into context. When we talk about malls, for instance, 80% of the value of the mall properties are controlled by public players, and the elephant in the room there is Simon Property Group. So I want to maybe talk about Simon and specifically what's going on with the department risk. And if you're a landlord like Simon, there was a recent story this week that Simon may potentially team up with Brookfield and take over JCPenney.
Yep.
This is not the first time that's happening. They've done it with Aeropostale. They've done it with Forever 21.
Yeah.
Why do you see this as going to be a recurring thing? And why would they risk the time and the effort to do that, especially with a struggling department store like JCPenney? Is it dealing with
they want to control the box. They just want to control the box. I think that's that simple, right? If you think about a typical mall, like the old-fashioned malls, right, you'd have 4 anchors, right, and then inline stores in the middle and all that, and you want to control the box, you want to control the experience, and that's what it's all about, right? So whether it's JCPenney, Sears, Kmart, right, these retailers who I don't believe will be around in 5 years, they still do own, in many cases they own this real estate, or they have long-term leases on them at the typical deal used to be when you used to build a mall is you'd cut your anchors a sweetheart deal on a long-term lease for them to then build their mall space out and do everything else. So that's the reason, right? And I think if you're Simon or you're Brookfield, right? Brookfield obviously controls GGP. I think it's smart business, right? I think you got to do that, and it's a little bit. Look, I think that, as I said earlier, I think the big challenge for retail right now is that the real opportunity for retail is redevelopment of some of these assets and changing them into experiential centers, something you can't get online, right? That is challenged right now because of all the restrictions on using experiential real estate. But I think ultimately, like any smart company, and I said before, I think David Simon's one of the smartest CEOs in the space. I think you got to go on offense a little bit. That's the best defense sometimes.
Gotcha. Just a quick reminder, everyone, if you want to get your questions in, you can submit them through the question box on the right-hand side. You should have a control panel. There's also a chat feature, so feel free to submit your questions from there. You mentioned a couple of years ago, I want to switch to storage. You mentioned, I remember a couple of years ago in your presentation, you were long-term bearish on storage, and that was mainly because of the introduction of driverless cars and the shadow supply with people's garages being freed up. Are you still maintaining that viewpoint today?
Yeah, look, I think so. I mean, that actually, my view came from Green Street, right? And I was actually, I hadn't thought about it, right? I mean, they did it in the presentation I sat in probably right before that presentation in Chicago, and they said the asset class that's been most impacted by technology in the last 10 years has been retail. Made sense. And then the one they thought would be most impacted in the next 10 years was retail. And then number two, they had self-storage, and I was like, self-storage, like, and the reality is that there is, I think this is the numbers, it's 6 times as much garage space as there in the country attached to single family homes as there are self-storage units in the country, in the entire US. And so I think the view was, look, if you have 2 cars, you go one that's driverless, you do whatever, or you just, then you start freeing up a lot of garage space, right? And then if some smart college kid comes up with an app where you can like start renting out your garage space to your neighbors, right? You do other stuff like that. Look, now I have a very good friend of mine who is a owner and CEO of a major industrial self-storage company, and he thinks I'm full of crap on this. He doesn't believe me at all, and it gives me lots of good reasons not to believe it. I gotta tell you, I kind of believe the secular trend a bit. I kind of believe the secular trend. Now, if you really get into deurbanization and you get into some of that, some of self-storage demand, I mean, the biggest growth in self-storage, honestly, has been in big urban centers on a relative basis, right? Now, people deurbanize, and maybe that's also going to be, that could be a headwind to the sector as well and all that. So who knows? I mean, there's the reality, but I will say this, our industry has been touched pretty lightly by technological disruption. There are very few examples of it, right? There's Airbnb, there's BTS and what it's, there's a lot on the what I'll call the brokerage side, right? So BTS is what they've done with office leasing, a lot of what's happening from an online perspective in terms of brokerage of properties. Look, I think COVID, one thing that's going to help a lot on is like residential, like, people are leasing apartments through seeing them on Zoom, right? And I think some of this is going to change some, right? But I think our industry, broadly speaking, I think we're still early in the technological disruption cycle. And I think I think we're foolish if we think it's not going to get to us like it's gotten to everyone else. So.
Gotcha. We have a question from June. This is going back to retail. Can you comment on what players are doing a good job of converting retail to experience-based spaces?
Simon's done the best job, I think. I mean, they've done, if you just look at a lot of their centers, I mean, Tubman as well, Unibuy, which is now Unibuy Rodamco, Westfield, like this is the longest name in ever, right? And so, if you just, I would say, if you think about your own neighborhood centers, right? If you think about the bigger ones, like the real marquee ones, and you just think about what they were 10 or 20 years ago and what they are today. Look, that's why these guys want JCPenney's back, right? They want JCPenney's back because, look, they might put multifamily on it. They might actually put some industrial distribution on it, right? Look, I do think that one thing that is absolutely going to happen is, by the way, you know who their biggest competitor is for the JCPenney stores? Amazon. Who? Amazon. Because I think this omni-channel thing is real. Like, I do believe, like,
Yeah.
Walmart, more limited degree Target, but then Amazon going the other way, right? I think that if you have the ability to have the right mix, interesting, you could just say, like, you could say Jeff Bezos is like Dr. Evil, like he's, in the last 20 years, he's driven the retail business to its knees, and now he's going to swoop in, and, and I say that with a huge amount of respect, it's like he's going to swoop in and, create this omni-channel thing where all of a sudden you've got physical real estate retail you go to, but also, if they create distribution centers, right? I mean, it's already amazing. I mean, it's a little bit slow during COVID, but it's amazing how fast they can deliver stuff already. But if they can get to a point where they've got a physical infrastructure to match your online infrastructure, I think that's a category killer, right? And so that's not experiential, but that's the part of what I'll call physical retail that I think is going to be the category killer.
Interestingly enough, I think it was Barron's this week that had suggested that Amazon purchase Macy's. And the funny thing is that it's almost like, what is the retail end game here? Because I don't know if it was Simon or who, but there was once I remember seeing a table of the top 10 mall tenants every decade. You know, if you're in the 80s, you probably had like Chess King up there, and then in the 90s, you had
I
something
used to be a
else.
chess. I love Chess King. That's
Hey,
awesome.
we're dating ourselves, you know, Camelot music, that sort of stuff. Retail goes through an evolution, if you will. So, but the curious thing is that Amazon does have a physical presence, especially if you consider just purely the fact that when you purchase something, you can actually return it at Kohl's,
Right.
right? Or you can go to a
Yes.
Kohl's
Yes.
bricks and mortar store. So
Yeah.
the question is, what is the end game? And I think Alibaba has already kind of had a
China's
presence.
way ahead of us on this. They're way ahead
Yeah,
of us, right? They've,
yeah,
it's kind of like skipping analog to digital, right? China and India hasn't quite gotten there yet, but I think they'll do the same thing.
gotcha.
I think omni-channel is the direction for retail. And then I think experiential. Look, what's going to get you up off your butt to leave your house to go somewhere that you wouldn't just be able to do from home, right? And that's experimental, right? So it's food, it's entertainment, it's others. That's just. And look, the issue with that, I'll tell you, is we own a lot of real estate that has, for example, a lot of restaurants. Restaurants is a tough business, right? It's a really tough business. The average restaurant I think is like lasts for 2 years, right? So it's something you have to constantly invest in and reinvent all the time. So.
Gotcha. Um, do you mind if we kind of squeeze in a few more questions here? I know we're
Yeah, for
about
sure.
15
I'm
minutes.
good.
Okay.
I'm good.
All right.
I'm
Great.
good.
Great. We have a
I
question about
feel we got
street.
to be in some penalty time after our little outage there for a few minutes, right? So,
I know it's so unfortunate, but we'll do the best we can. So
yeah.
this question is about street retail. I think the name is Quasi. What do you think happens to ground floor retail space of office buildings?
So, look, I think it's a great question. So, especially in these urban dense areas, right? I think part of the issue, like let's use New York City as an example. So, Fifth Avenue, Soho, et cetera, rents doubled from 2010 to 2015, right? So 100, they weren't $100, more like $1,000, but $100 rents with $200 rents. And then already by a year ago, they were down 50% off that peak, but they were still up. You're down. If you go up 100, you're down 50. You're still up a lot, right? And there's a huge issue there, right? So meaning that a bunch of tenants were going, space was empty, right? There's probably 25% vacancy in New York City high street retail because the rent levels that people bought it underwrote when they bought were significantly above what people could afford to pay now, right? And I think especially with everything we just talked about was having a retail. So here's the thing. High street retail works when I'm going to keep picking on restaurants because high street retails work when food and beverage tenants can afford them. That's when it works because that would if you really have a 24/7 city and all that, that's the metric in my mind where it works, right? So TGI Fridays cannot afford to pay the same rent that Louis Vuitton would have at one point, right? Um, Louis Vuitton does not need as much physical real estate anymore because they've got a bunch of stuff going on, including online, right? And especially, if you can order, well, thank God it's not a Louis Vuitton, but between my wife and my daughter, they order a lot of stuff, right? But if you can buy it, try it on, and then you can return it to a physical store and go exchange it, that's pretty powerful, right? Yeah. So I do think if I had to part of this is part of being an investor is like, okay, where are you going to make that bet? I would much rather bet on high street retail than bet on, I'd buy the King of Prussia Mall all day long, but it's never going to be for sale, right?
Yeah,
But then bet on what I will call second tier suburban real estate. To me, I wouldn't touch that stuff. But high street retail, because I think high street retail has other uses. Right? It really does. It has other uses and applications that I just don't think. Now, look, another headwind of, I'm sure this is the case in Boston, like definitely the case in New York City. Every other corner is a Starbucks or a bank branch, right? And I got to tell you, like I'm not even sure who goes to bank branches anymore. But so you do want. I do think there's still some secular stuff that's going to be a headwind to that. But I would still rather take a bet on the ground floor space. We won't call it retail. The ground floor space under an office building I own in Midtown Manhattan than some suburban retail asset.
gotcha. We have a question regarding more of the technicalities of negotiating your leases with your tenants, and since you're involved in that, maybe you can provide some perspective here. Do you expect any changes to commercial lease agreements going forward, or do you think tenants are going to start working more clauses that deal with pandemics and that sort of stuff?
Yeah, probably. Yeah, I think they will. I think, look, we're already seeing it in retail. I think the number one thing we saw from retailers, either ones that didn't just shut down, were trying to immediately flip to a percentage rent, model. So I do look. I think so. With retail, we're definitely going to see it in my mind. I think we're already seeing it, and I think that I think the issue there is going to be a landlord is going to have to decide. One of the problems with retail is it requires a fairly large tenant improvement allowance. I think it's really hard to do that as a landlord and also not have the guarantee of what your income is going to be. So that might impact how that works. I think with office, look, what you've seen happen, and WeWork did it, right? So it wasn't Boston Properties doing it. It was WeWork doing it. And then, so tenants have a desire to have more flexibility with their office space, shorter term leases, more, more flexibility to go up and down, and they'll pay a premium for that, right? Um, WeWork provided, I'd call that, they were the clearinghouse for that, right? Because they would take the long-term lease from Boston Properties and then they would subdivide it, do that. I do believe that in a world where there's less WeWork or whatever else, that I think tenants are going to still look for more flexibility in their office space, especially given what we talked about a few minutes ago, where I think we're going to have 3 to 5 years of uncertainty of how that's all going to unfold. So I think I think that's also going to be the case. Residential, not sure. I'm not sure there's going to be much of a change there. Like, I think that's just going to ebb and flow. The biggest risk in residential to me actually is it's actually not the deurbanization. It's more what I will call activism, right? And, we've seen it happen in New York in the last year where, the rent control laws were, I would argue, arbitrarily changed by, by the legislature. To the benefit of tenants, to the detriment of landlords. But what ended up happening is a lot of landlords just said, I'm out, I'm done, I can't do this, right? And so, but I think you're going to have a big move there. I think that's part of the progressive movement. And I think that's definitely a threat. Because you asked the question before, look, I got to tell you, I'm probably, for most of my career, I've focused on kind of coastal gateway cities as an investor. We're actually spending more time looking at stuff in red states right now, where we just believe that there's going to be less of that as a risk factor.
Yeah, I agree with you on that. I remember I was looking at an office play, and they had a large presence in Austin, Texas, and those were large corporate tenants that were taking on. They were building these buildings, and before they broke ground, they were already leasing them out. And those tenants were Amazon, Facebook, investment grade tenants, basically. And so it's just, and going back to office, I think you would kind of classify that as well as we talked about with multifamily. You would kind of look at the Sun Belt as kind of a more of an opportunity, such as Atlanta, Nashville, Austin, perhaps, versus say New York and San Fran. Would you agree with that stratification?
I think so. Yeah. Look, we just got to make sure. Look, the one, we got to just make sure the job growth is really going to be there, which I think it will be. But I think that's the issue. Look, the biggest issue with a lot of those other markets are, I said the biggest thing we need in real estate is demand. The biggest threat is supply, right?
Yeah.
And I think barriers to entry, the reality is they're just lower in some of those other markets. Like, I grew up in Tennessee, and like I look at Nashville and how Nashville has exploded, right, and grown. But part of the reason it's been able to explode and grow is you had land in every direction, right? And so, if you want to build something we own a lot in Boston. You want to build something in the financial district, you got to buy something, empty it out, tear it down, and build something new. Same in Manhattan, right? That's not the issue in a lot of these other markets, including some of the cities you mentioned, like Atlanta. There's plenty of, places to develop new assets, right? And that always caps your upside in my mind, because as soon as a market starts recovering and you get above trend growth, people add new supply. So
Yeah.
that's the other thing you got to think about.
Within residential, if you look at manufactured housing, multifamily, and then single family residential, I don't know if you do much of that. How would you prioritize those in terms of the opportunity?
So we don't do a lot in what I'll call structured residential. I am actually pretty positive on single family residential. We don't have any exposure right now, but I'm actually pretty positive on it going forward. I was a little skeptical about it coming out of the financial crisis. I just didn't know how it was going to work, and whatever. But look, someone like Invitation Homes has been super successful because they got to the scale to make it work, right? Because on a unit basis, it's inefficient, right? It's pretty inefficient. It's very efficient to have 100 units in the tower at an apartment building and service them. It's very inefficient to do 100 homes. But through a combination of technology and a lot of stuff, and now scale, they've been realized, for all the reasons I mentioned earlier, that I think the home sales market is going to be tough for the next few years. People will, again, if they're deurbanizing, they might still want to live in a single family house and not be vertical or even a garden style apartment. So I actually think the dynamics are actually pretty positive for single family residential for a while, right?
Okay.
To me, it's a zero sum continuum, right? So if it's good for single family rentals, it's bad for single family purchasing. If it's good for multifamily, it's bad for owning, right? There's a continuum there, because there's one person that has demand for one unit, right? Not one person looking for multiple things. So that's I'm positive on it.
I'm gonna squeeze in one more question, if you don't mind.
Okay,
And
sure.
so a lot of our members are heavily focused in ESG investing, and I don't think we've ever spent much time talking about how sustainability analysis is incorporated in the real estate world. So could you perhaps kind of cover how you incorporate ESG analysis in the real estate world?
So it's actually one of the things I'm most proud of, and I should take no credit for it, because it was our merger partner, Bentall Kennedy, that has, ESG's the sustainability, the environmental part has been huge front and center part of their focus. So GRESB, which is the organization in the real estate that really kind of is probably the leader in terms of evaluating people's performance in terms of how green friendly they are. Bentall has been number 1 or 2 ranked for 10 years in a row, right? In terms of in the space in North America, which I think is pretty extraordinary, right? So what does that mean, right? What are they doing in terms of new developments? What are they doing in terms of refurbishments? How green are the buildings? There's a huge amount of, there's a huge kind of number of things around that. I actually believe in the environment. The E and the ESG has become table stakes. I don't believe it's. I don't, meaning that not to delegitimize it. I just think that if you do not have a forward-looking environmental sustainability policy, you're going to be left behind. It's no longer what you need to do to differentiate yourself in a positive way. If you don't do it, you're going to be left behind. My own view of the ESG, honestly, Gary, is I think right now in the next 5 years, the S is going to become more important, but not the S of sustainability, but the S of social, right? And you and I talked about this when we did a prep call last week. I really believe, and I hate to say it this way, but I really believe when we look back in 3 or 5 years, what we're going to remember about this time period, we'll remember the recession. We're going to remember COVID, but I think we're going to remember George Floyd more than we're going to remember COVID. In a way, like I think in terms of the change it has to have, and I think it's going to have in our country. Look, when you got the president of the United States calling on a rally this weekend on national TV, calling things the Kung flu, that ain't the right thing to do from a social perspective, right? So I really believe the private sector, local government, this leadership is super critical. And it looks personally important to me. I'm a minority in the space, and first generation immigrant to the country, right? I think the US is the greatest country in the world, but we could do better. And so when I think about ESG, the environmental sustainability part, it's super critical, but everyone's focused on it. And especially the younger generations, that horse has left the barn, right? Mm-hmm. Social is in my mind, the critical thing we got to focus on in our industry. Our industry is not diverse enough. I don't know, but a lot of things. We're real estate. I'm a real estate person. I'm going to talk about real estate. We're not diverse enough. We're not inclusive enough, and that is going to be much like I think environmental are now table stakes. I think in the next 3 to 5 years, if you don't have the right social and therefore also governance plan, those are going to become table stakes. I really hope they do, because I think it's super critical.
That was
sorry to sit there and pontificate for a minute, but it's important to me. So.
No, I really appreciate expanding on that, just because we've always spent a lot of time on ESG, and we've never thought, I don't think we spent much time thinking about how it works within real estate. So that was really, really helpful. We are pretty much out of time here, so I want to thank you again for doing this. This was a fantastic discussion and presentation. And I apologize once again to our audience for the technical glitches. It happens.
It happens. Well, when you piece together the recording, it'll be interesting how long you let me sit there and ramble before you just cut it off, because I rambled for a while, and then when I couldn't move any screen, whatever, it's all good. You know what?
Yeah.
Harry, it's actually authentic. It was authentic because that's what work from home is all about, right? It's the reality.
Absolutely.
But thank you for having me. I'm happy to happy to have done it.
Do you have any final comments, any takeaway comments for our audience before we go?
You know, look, I think everyone's a real estate expert, is what I think, right? I think my mom is a actually I was gonna say she's primarily been a homemaker in her life, but she's actually been an entrepreneur too. But she's a real estate expert. She knows what she likes, what she doesn't like, right? And I think, when you think about Peter Lynch and Fidelity when he wrote his book about investing, and you invest in, or even Warren Buffett, you invest in the products you like. I should think it's true about real estate. We're all real estate experts. We know where we like to work. We know where we like to shop. We know where we like to live, right? When you travel, you know where you like to stay, right? That is actually, to me, one of actually the most important parts about real estate. And that's one of the reasons I've been in the industry for 30 years, because it's so tangible, but it's also like you can get feedback and input from anyone, anywhere. Everyone's got a perspective on it, right? So that's what I would say about real estate, right? It's, I wasn't smart enough to be a hedge fund guy or anything else, so this is what I did. But I've always liked the tangible nature of the asset class, and I always like the fact that you can get input from people, everyone, about it. So,
well, that's fantastic. I really appreciate that. So thanks again for doing this, and thank you to all of you in the audience. Remember to fill out our survey. We'll be sending one shortly after this program. I hope you enjoy the rest of your week, and until then, we'll see you next time. Take care.
okay, thank you. Bye-bye.